$10 million. That is what Google paid at auction on Friday the 14th of August, 2026, for everything a dead airline ever wrote down about itself. Not the passengers. This is the part almost every account of this story got wrong, and I will show you the page where it is wrong. Google did not buy Spirit Airlines' customer list. It bought Spirit Airlines' inbox, 100 million emails, 500 million items out of Microsoft Teams, 516 source code repositories. Every payroll record since June 2016, employee files going back to August 1986. Here is my thesis, and everything after this is the working. The interesting thing about this sale is not that a technology company bought data in a bankruptcy. Companies have bought each other's filing cabinets for as long as there have been filing cabinets. The interesting thing is what was in the cart, because it tells you what these firms think they are short of. They are not short of text. They are short of a record of an organization actually doing its work, arguing, deciding, escalating, redlining, closing a ticket. And the second thing, every privacy protection in that contract was written for customers. Almost nothing in the box is a customer. The people whose lives are in those files are the people who worked there. Nobody asked them. Chapter 1, 2.5 hours on a Friday. Most of what you can know about this sale comes from a sworn declaration filed 3 days after the fact by a vice president at PJT Partners, the investment bank running the wind down. It is 8 pages. It is signed under penalty of perjury under Section 1746 of Title 28. And it is the most useful document in the case, because a banker defending an auction to a judge has to say what actually happened in the room. So here is what happened in the room. Spirit Airlines filed its second Chapter 11 petition on the 29th of August, 2025 in the Southern District of New York. It never came out. In May of 2026, the airline stopped flying permanently after 34 years, and the case turned from a reorganization into a liquidation. What follows is what a liquidation is: lawyers selling the pieces. By August, the pieces included the data. The declaration says the debtors received multiple bids and qualified 3 of them. The auction opened at $5 million. It was conducted by remote teleconference. It ran, the banker estimates, about 2.5 hours, and at the end of it the price had doubled. Now read the next sentence carefully, because it is the sentence that tells you this was not a normal asset sale. The banker writes that in selecting the opening bid, the debtors considered, quote, not only economic factors, but also non-economic factors, such as whether the sale would provide for a documented and acceptable identification process. And then this. The debtors emphasized that, given various privacy laws and other process considerations, these non-economic factors may be outcome determinative. Translated, we told the bidders up front that we might take less money from whoever gave us the better privacy story. That is not boilerplate. In a moment I am going to show you the 2 occasions on which they did exactly that and what it cost the estate. The opening bid came from Google, $5 million in cash with a third-party identification process paid for by the buyer. After numerous rounds, the banker's phrase, Google closed at $10 million, all cash. Merker.io Corporation was designated the alternate bidder at $7.5 million. The margin between them was $2.5 million, and the declaration cites that margin as evidence that the value of the data was properly tested. There is one more line tucked into a footnote, and it undoes a lot of the coverage. Footnote 4. The debtors are separately conducting a marketing process for their customer list and anticipate seeking approval for a sale of their customer list at a future hearing. So the customer list was never part of this. It is its own sale still to come to somebody else. Which raises the question this whole video turns on. If Google was not bidding on 97.5 million passenger profiles, and it was not, then what was it bidding $10 million for? The answer is on one page. It is page 18. Chapter 2, The Manifest. Attached to the auction notice is a spreadsheet, one landscape page printed small. It is titled Spirit Data Categories, and it has a column on the right-hand side headed in plain words, Google's Data Purchase Request. Every row says either included or not included. I want to read you the included rows because I have not seen anyone read them out, and they are the story. Finance and accounting, 851,000 invoices, 97,000 vendor records, revenue accounting, cost accounting, and treasury out of S&P financial models and forecasting files. presentations covering capital projects, budget walkthroughs, and board approvals, and a line that made me sit up: corporate development documents, deal pipelines, company and industry analyses, data room materials, due diligence review reports, investment committee reports, lender materials, merger and acquisition fairness opinions. Operations: 763,000 flights flown, 5 million crew pairings, over 1.2 million fuel slips, maintenance records, parts received, parts transferred, scheduled tasks. Team member: just over 1 million time cards from December 2012, 175,000 employee records beginning in August of 1986, 3.4 million payroll records, 148,000 employee tax forms, corporate training records, crew training records, applicant tracking documents. Employee documents: 100 million emails across 80,000 accounts from 2018, 17 million OneDrive items, 20.5 million SharePoint items, 500 million items from Teams, 667,000 IT service tickets. Code: 516 source code repositories, web, mobile, and backend, around 30 million lines of code. 43,000 pull requests, and I am quoting the schedule here, including metadata such as descriptions, comments, and review threads. 372,000 commits with full Git history, diffs, messages, author information, and timestamps. Bug reports and their discussion threads. Continuous integration logs, automated test results, code coverage reports. Legal forms and templates. Legal memos and policies including product counsel and intellectual property counsel reviews. Litigation case files. And agreements including the schedule's words, redlined or versioning draft to final contract histories. Commercial agreements. Merger and acquisition contracts, employment contracts, and non-disclosure agreements. Now stop and look at the shape of that list. It is not a customer database. It is not a marketing asset. It is the complete paper trail of an organization arguing with itself for 8 years, not just what Spirit decided, how the decision moved. A draft contract and the red lines that turned it into a final one, a pull request and the review thread that changed it, a ticket and everything that happened to the ticket. And the delivery instructions confirm the intent. For the Microsoft data, retain and transfer everything inside the native Microsoft 365 environment. For everything else, machine-readable formats, the schedule name CSV, JSON, native SQL dumps. For the code, bare Git repositories, 1 zip file per repo, and JSON lines for the metadata. Nobody archives a dead company like that. That is a shopping list written by people who intend to train on it. Chapter 3: What was not in the box. Here is the other half of that page, and it is the half that got reported backwards. Under the heading Customer Behavior, the schedule lists what Spirit had: 97.5 million customer profiles, 50.2 million free Spirit loyalty members, 2.2 million Savers Club members, 740,000 co-branded credit card holders, 13.7 million active email addresses, 7.3 million telephone numbers, nearly 15.8 million handled chat sessions, nearly 31 million recorded customer service calls. Website analytics: 43 million unique users year to date, 41 million searches, 2.4 million purchases, post-purchase surveys, net promoter score, disability service requests. Department of Transportation complaints. Every single one of those rows says not included. Now, on the 18th of August, a technology news outlet published a story about this sale under the headline that Google had bought a crashed airline's data. The stand first read: $10 million buys over 100 million emails, 30 million recorded phone calls, reams of stuff from Teams, Oracle, and SAP. The body said Google, quote, also now owns over 30 million recorded customer service calls and more than 15 million customer service chat records. It does not; those two rows say not included. The article linked the court document in its second paragraph. That story went to the front page of Hacker News and drew several hundred comments. Most of them were about the call recordings. And deep in the thread, one commenter posted the correction. None of that customer data is included in the purchase. Page 18 of the linked court document is the source of these record counts, and the column on the right lists all of it as not included. I checked, the commenter is right and the article is wrong. I downloaded the same document from the same court's claims agent and read page 18 myself, which took about 4 minutes. I am not telling you this to score a point on one publication. I am telling you because it is the exact failure mode this whole beat is prone to, and the shape of it matters. Nobody fabricated anything. Somebody skimmed a 35-page filing, took the biggest numbers off the page, and did not notice that the column deciding which of those numbers were being sold was on the far right in small type. Then the striking version traveled because the striking version always travels. And notice which direction the error ran. It ran toward the story everybody already believed, that Google was buying your phone calls. It is much harder to get attention for the true version, which is that Google was buying somebody else's staff meetings. One caveat, and it is a real one: the customer data being excluded here is not a mercy. Footnote 4 of the banker's declaration says the customer list is being marketed separately for sale at a future hearing. Spirit's passengers are still for sale, just not to Google and not in this lot. Chapter 4: What it costs to not scrub it yourself. I said earlier that the estate told bidders it might take less money for a better privacy process, and that they did it twice. Here is the receipt. Round 1. Google is on the table at $5 million using its own form of bill of sale, under which a third party does the identification and Google pays for it. Merker overbids, and the declaration records Merker's overbid as a choice of 2. Option 1, $5.2 million on Google's form third-party identifier buyer pays. Option 2, $7 million if the terms let Merker complete the identification process with its own tools in-house. The debtors, having consulted the creditor parties, determined that $5.2 million was the highest bid for that round despite the lower price. Read that again. Merker put an extra $1.8 million on the table for permission to do the scrubbing itself, and the estate turned it down. It happened again at the end. Google's final bid was $10 million, Merker's alternate bid was $7.5 million, but the declaration adds this: Merker also offered $10 million subject to having an in-house rather than third-party identification process. The debtors chose the $7.5 million version as the alternate bid. So on the record, in a document sworn under penalty of perjury, a bankruptcy estate with creditors to pay declined $2.5 million rather than let the buyer identify the data with its own tools. I find that genuinely clarifying, and for 2 reasons that point in opposite directions. The first is a point in the process's favor, and I want to be fair about it. This was not theater. Somebody in that room understood that who performs the identification determines what identification means, and they were willing to spend real creditor money to keep it out of the buyer's hands. That is a more serious privacy posture than most commercial data sales ever get, and the union objecting to this sale says so explicitly. It calls the protections in this contract real and not obviously required. The second point cuts the other way, and it is the one that stayed with me. If a third-party scrubber were merely a formality, nobody would pay $1.8 million to skip it. Merker's willingness to pay a premium to run the process in-house is a market price on the difference between identifying data yourself and having somebody else do it. Both parties in that room agreed the difference was worth millions, which means both parties believed the choice of scrubber changes what comes out the other end. Hold that thought, because there is a clause in Google's own contract that partially collapses it. The identification agent, Section 1, is one or more third parties, quote, acceptable to or designated by buyer. The certification, Section 3, must satisfy the buyer's reasonable satisfaction. And under Section 4, the buyer is entitled to review and comment on the identification process, with the seller obliged to give good faith consideration to those comments. It is a third party. It is a third party the buyer picks, the buyer pays for, and the buyer signs off on. Chapter 5: What the word "identified" is doing. The word appears in the title of the asset. The lot is not called the emails or the corporate archive. It is called the Deidentified Data. That is the name on the docket. So let us do the boring thing and read the definition, because the definition is not the buyer's and it is not the seller's. It is California's. Section 3 of the Bill of Sale requires the identification agent to certify that the assets have been identified in accordance with applicable laws, including, and I am quoting, using the standard for de-identification set forth under the California Consumer Privacy Act, as amended, regardless of whether such statute does or does not apply to the assets. Regardless of whether it applies, they borrowed the test on purpose, knowing it might not govern. Now go and read that test. It is Section 1798.140, Subdivision M of the California Civil Code. De-identified means information that cannot reasonably be used to infer information about or otherwise be linked to a particular consumer, provided the business takes reasonable measures, publicly commits to maintain and use the information in de-identified form and not to attempt to re-identify it, and contractually obligates any recipients to comply. 3 prongs. Now look at Section 1, subsection C of the sale agreement. Buyer publicly commits to maintain and use the de-identified data in de-identified form, and that it will not intentionally associate the de-identified data with any person or household. And buyer may transfer the data onward to third parties, provided buyer contractually obligates those transferees to comply with this same section. That is the statute transcribed into a contract, almost prong for prong. With one substitution I keep turning over. The California test says the business must publicly commit not to attempt to re-identify the information. The contract says the buyer commits not to intentionally associate the data with any person or household. Those are not the same sentence. One forbids trying, the other forbids succeeding on purpose. In a business whose entire method is building systems that find latent structure in data without being told to, the gap between those two verbs is not a lawyer's quibble. There is also a lovely piece of drafting at the end of that clause. If the buyer has not made such a commitment in a broadly accessible public document, the contract suggests a publicly posted privacy notice, then the buyer agrees that this agreement itself constitutes the public commitment required by law. The public commitment can be the private contract. That is how the prong gets satisfied either way. And then there is the phrase that made a union file an objection. The certification in Section 3 has a final condition, and it is 11 words long, while preserving referential integrity across the data set. Referential integrity means the joins survive. Employee number 447 becomes a random token, but it stays the same random token in the payroll table, the timekeeping table, the training records, the crew pairings, and the mailbox. The names go, the graph stays. It has to stay because a corpus of disconnected fragments would be worth a fraction of $10 million. The whole value of the thing is the thing that makes it linkable. Chapter 6, the payload is the staff. On the 18th of August, 4 days after the auction and 1 day before the sale was due to be approved, the Association of Flight Attendants filed a limited objection. 9 pages signed by their bankruptcy counsel. It is the sharpest document in the case, and I think it is right. Its central paragraph is one I would have paid money to write. Nearly every consumer-facing category is designated not included: customer profiles, loyalty data, email addresses, chat sessions, call recordings, telephone numbers, website analytics, transport complaints. Nearly every category under the heading team member is designated included: time cards, employee records, business travel, training, payroll, tax forms, employee documents. And then the line. The privacy architecture of this transaction is consumer-facing. Its payload is disproportionately employee-facing. The union is careful about what it is not saying, and I am going to be equally careful. It says it does not seek to unwind the auction or to stop the estate monetizing data assets. It says the exclusion of personal data, the exclusion of privileged material, the California certification, and the buyer's public commitment are real and were not obviously required. It says explicitly that it does not contend the Bankruptcy Code's personal information provision is even triggered here. Its argument is narrower and harder to answer. Deidentification asks whether a record can be traced to a named person. It does not ask whether the contents of the record are confidential. Those are different questions. A flight attendant's disciplinary correspondence, a training deficiency, a leave or accommodation request, an internal team's exchange about staffing or scheduling grievances or the union itself, a payroll adjustment history and what preceded it. Strip the name off any of those and the sensitivity is entirely intact because the sensitivity was never in the name. It was in the substance. And the sale agreement, the union points out, does not merely omit a screen for that. It forecloses one. Section 3 commits the debtors that no portion of the assets has been deleted, modified, or removed, other than through deidentification, ordinary course changes, and de minimis removals to protect the debtor's own privilege. The estate's lawyers preserved a carve-out for the estate's lawyers. There is no equivalent carve-out for anybody else. Then the union makes the point about size, and it declines to overreach in a way I want to credit. It writes that it does not make a technical claim that any particular record can be re-identified, and it does not need to. It notes only what the agreement says. The joins are retained by design. The crew base population per the schedule is 4,600 people. Describe a small, highly structured population across linked operational and communications data spanning more than a decade, and the risk that identifiable individuals or small identifiable groups can be inferred is not speculative. Two more things compounded. The buyer may pass the data onward to unnamed third parties on nothing more than a contractual pass-through, and the flight attendants are expressly denied third-party beneficiary status by Section 12, so they cannot enforce any of it. They are the subject of the transaction and not a party to it. Chapter 7: A Law Built for Customers. I want to explain why no consumer privacy ombudsman was appointed in this case, because the answer is not a loophole. It is the statute working exactly as written, on a transaction it never imagined. Section 363, subsection B, paragraph 1 of the Bankruptcy Code is the provision that lets a trustee sell property outside the ordinary course of business. Bolted onto it, after 2005, is a privacy condition. If the debtor, in connection with offering a product or a service, disclosed to an individual a policy prohibiting the transfer of personally identifiable information to unaffiliated persons, and that policy was in effect when the case began, then the trustee may not sell that information unless the sale is consistent with the policy, or unless the court approves it after appointing a consumer privacy ombudsman under Section 332. The ombudsman is a real office. Section 332 requires the United States trustee to appoint one disinterested person, not later than 7 days before the hearing, to appear and advise the court on the debtor's privacy policy and the potential losses or gains of privacy to consumers. So why is there no ombudsman here? Because of the definition. Section 101, Subdivision 41A, defines personally identifiable information for these purposes as information provided by an individual to the debtor in connection with obtaining a product or a service from the debtor primarily for personal, family, or household purposes. Then it lists what counts: name, home address, email address, home telephone number, social security number, credit card number. Provided by an individual in connection with obtaining a product or a service, that is a customer. That has always been a customer. An employee does not obtain a product or a service from their employer for personal, family, or household purposes. They go to work. So the flight attendant's payroll history, training file, more than a decade of time cards, and mailbox are not personally identifiable information under this statute, no matter how personal or how identifying they are. The trigger never fires. No ombudsman, no hearing on privacy. The sale proceeds as an ordinary asset sale, because in the eyes of that provision, that is what it is. The union does not fight this. It concedes the point and turns it into the argument. The statutory scheme the parties borrowed from was built for customers, and no comparable screen has been applied to the employment record this transaction actually conveys. There is another provision it reaches for instead. Section 107, subsection B, paragraph 1, which requires the bankruptcy court on request of a party in interest to protect an entity with respect to a trade secret or confidential research, development, or commercial information, with no reference at all to whether anybody is identifiable. And Section 105 and Section 363, subsection E, for the proposition that the same power that lets a court approve a sale lets it approve a sale on conditions. Which is a good argument. It is also an argument being made in 2026 under a privacy provision Congress wrote in 2005 about a category of asset whose price, until this auction printed one on a public docket, was not something anyone outside the room could see. Chapter 8: Why a Dead Airline's Inbox is Worth $10 million. Now the question I actually care about, and the one the documents can only get me part of the way to. What Google has said publicly is thin. A spokesperson told Forbes the data would be helpful in improving our products and AI models, and that Google will not receive any personal information from this dataset. Axios reported the same purpose. That is a statement to reporters, not a filing, and it does not say what the data is actually for. So we are left with the manifest, the market, and the argument in the thread. The manifest first. Look at what is included and what is not, and ask what a buyer after advertising data would have taken. They would take the 97 million customer profiles, the loyalty file, the 13.7 million email addresses, and the website analytics. Every one of those is marked not included. Whoever wrote that column was not shopping for an advertising asset. Then look at what they did take and how they asked for it. Pull requests including descriptions, comments, and review threads, commits with full diffs and messages. bug reports and their discussion threads, contracts with their redline histories draft to final. In every case, they asked not for the artifact, but for the artifact and its argument, the thing, plus the record of how the thing got that way. That is what you buy if you are trying to teach a system to do the work, rather than to describe it. Now the market. The underbidder was Merkur, and what Merkur does is not a mystery because it is on their homepage, organizing human intelligence to power the AI economy. Their public job board, the day I looked at it, was advertising for corporate and controllership accountants at $80 to $120 an hour, and sales and marketing experts at $65 to $90. That is a company that pays professionals by the hour to generate exactly this kind of enterprise work product for AI labs. And it bid $7.5 million for an archive of a real company that had already generated it, for free, by existing. That is the clearest signal in the whole affair. Two different buyers, arriving from two different directions, priced one dead airline's paperwork against a national labor market for the same material. And the argument in the thread. Let me attribute that properly. These are pseudonymous commenters, no occupation or employer verified, and their reasoning is worth something only because it is reasoning. Several converged on the same explanation. Progress on tasks where you can automatically check the answer, code, mathematics, has run far ahead of progress on ordinary office work, because for office work there is no cheap way to manufacture the training signal. One put it plainly, this data shows exactly how a company of thousands of employees works and coordinates. Another raised the obvious objection that most email is inane. A third raised the funnier one, which is that the company in question went bankrupt. There is published work behind the scarcity itself. A forecasting paper first posted in 2022 and revised in 2024 concluded that if the trends of the time held, models would be trained on datasets roughly equal in size to the entire available stock of public human-generated text somewhere between 2026 and 2032. We are in 2026. Chapter 9: What would change my mind? Let me state plainly what has not happened, because a great deal of the coverage read as though it had. The sale is not approved. The auction selected a winner on the 14th of August. The hearing was set for the 19th. On the 18th, after the flight attendants filed, the court adjourned that hearing to the 9th of September, that is Reuters reporting on the 18th, and the union says the same on its own website. No data has moved. Under the agreement, the datentification has not even been designed yet. It happens after a sale order, not before. Everything I have described is a contract that a judge has not yet approved. So here is what I believe, and here is what would break it. I believe the manifest is the tell. That the reason a bankrupt airline's internal paperwork drew 3 qualified bidders and doubled in price in an afternoon is that the market for training data has moved from text to work, from what people wrote to how an organization actually got something done. $10 million is a very small number for Google and a very large number for a liquidation. It is a public docketed price on an ordinary company's complete institutional memory, and I could not find another one. I would abandon that reading if the Deidentified corpus, once processed, turns out to be so heavily stripped that the referential structure is gone, in which case Google bought a pile of disconnected documents and I have overread a spreadsheet. I would abandon it if Google's use turns out to be narrow and operational, an aviation scheduling model, say, rather than general. And I would abandon it if this stays a one-off. If 2 years from now no other liquidation has run a data lot like this one, then the right description was opportunism, not a market. Watch for the opposite signal too. Watch whether the customer list, the separate sale in footnote 4 still to come, fetches more or less than the employee records did. If a dead airline staff emails are worth more than 97 million passenger profiles, that inversion is the whole story in one number, and it is a number this case will actually produce. And on the second thesis, the one about who is in the box, I am less uncertain, because the union has already made the argument and the document does not answer it. The privacy engineering here is genuine. It is also calibrated entirely to identification, and identification is not what is at stake in somebody's disciplinary file. The bankruptcy code's privacy trigger asks whether an individual handed information to a company in order to buy something. The people in these files did not buy anything. They worked there for years and produced the asset by working. And when the company died, the asset was sold and they were told it did not concern them because their names had been removed. There is no consumer privacy ombudsman in this case, and that is not a scandal. The statute simply does not reach them. The 9th of September is when we find out whether a judge thinks it should.